I hope you're going to be doing quite a lot over the next 10 minutes. A number of weeks ago, our education coordinator made a statement that if something in B&I isn't working for you, then it's your fault. Some of you have said to me that you find difficulty in referring me because of what I do. So my 10-minute presentation today is about making it easy for you to refer me. I can understand that you might have difficulty in getting referrals from me because what I do can be quite complicated and confusing. But ladies and gentlemen, therein lies the opportunity. If your referrals are having difficulty understanding what my industry is about, you should say to them, talk to Joe. So my job this morning is to help you to create referral opportunities for me. So let's get started. Does anybody here know anybody who has a mortgage? Please raise your hand. Thank you very much. If somebody you know has a mortgage, then you should tell them to talk to Joe. So why would you do that? A couple of examples. Single guy buys a house, takes out a mortgage, has a life mortgage protection policy in his own name only, subsequently gets married, has a family, and Joe comes along, reviews his mortgage protection policy to discover the policy is still in his own name only. That particular individual now has a joint life mortgage protection policy, which means that in the event of the death of either of them, the mortgage gets paid off, and the policy actually costs less than it was paying originally. So that's one example. Another example is a guy who now pays 30% less, come back to our education slot this morning in saving money, review existing mortgage protection policy, example, 30% less now than they were paying 3 months ago. Thank you, Joe. I can arrange a mortgage protection policy which guarantees to pay off the mortgage, regardless of the interest rate applicable at the time of death. Most mortgage protection policies only guarantee to pay off the mortgage provided the interest is below 6%. The big one is that a lot of people have been sold mortgage protection policies, typically by their bank, which includes a thing called critical illness cover. Critical illness is something that pays a lump sum in the event of you getting cancer, heart attack, etc. Brilliant idea, but having it included in your mortgage protection policy means that it's assigned to the bank. So if you get a heart attack, your mortgage gets paid off. But hey, believe me, if you get a heart attack, having your mortgage paid off is not going to be your biggest financial priority. So my suggestion and recommendation is that you separate out the life assurance part and the serious illness or critical illness part, so that if you become seriously ill, you can pay off the mortgage if you want, but you'll find that there will be bigger issues like medical expenses, etc., which the serious illness or critical illness part can use. If you want to refer me to somebody who has an existing mortgage protection policy, a very easy way of doing that, and there's one of these for everybody in the audience on your desk, is a letter of authority. And if you have your client sign that and put the policy details on it, send that on to me. I can get the information from the company that the person holds the policy with and go from there. I really didn't want to use this slide, but I'm using it for two reasons. One is I was off on holidays for a couple of weeks ago, and I lost a client while I was on holiday. The second reason is that this slide talks to a lot of what I do and a lot of the contribution that I make to my clients. So why life assurance? The three things that come up in a life assurance conversation that I have with clients with your referrals are death, income, and education. I quite harshly say to people, would you prefer to leave your family with nothing? If they're saying, I don't want life insurance. Would you prefer to leave them with nothing or less than nothing? So as a minimum, I always try and coach people where possible, provided people are insurable and provided people can afford to do so. That as a minimum that we offset the debt, that we make sure that in the event of the death of the person who has the debt, that in the event of their death, that the debt is paid off. The second one is in relation to replacing income. In a situation where, particularly where the household income is coming primarily from one breadwinner, I help people to understand and to work out the numbers on taking the gross income that somebody brings into the house, work on that back, and figure out what the net loss to the household would be if that person were to die. Now, if somebody's earning 60 grand a year, it doesn't mean you have to replace the 60 grand a year. Because first of all, you go from gross income to net income. Then you take off the amount that doesn't have to be earned anymore because the mortgage is going to be paid off. And hopefully there'll be some income coming from the state. So it actually can turn out to be the 60 grand can end up being replaced 10, 15,000 a year over a period which typically matches the financial dependence period for children. So your 60 grand a year could work out at replacing 15,000 a year for 10 or 15 years, something like that. But I help people to work that number out for themselves. And go back to what Mela said about the proudest moment. For me, seeing the light going on for people for the first time ever, where they get to understand the numbers around, how much life insurance I should actually have, rather than being told something or sold something. The other one is about education. In fact, a lot of the conversations that I have about life insurance end up talking about these guys. Oh no, sorry, not those guys. These guys, yeah. Education as a parent of 4, 3 and 3rd level, 1 and 2nd level, is a bloody painful exercise from a financial point of view. I'm sorry to say this, but we're now looking at a situation where, you remember back in the day we did 3-year degrees. They're now 4-year degrees plus a master, or some other excuse for another year. So you're looking at 5 years. Potentially, particularly if fees get brought back, and you're potentially looking at 15,000 a year. Certainly, at least 10 easily. To educate a child at 3rd level, you're looking at 75,000. And I help people, parents, to provide for that education cost in 2 ways. Most parents will say to me, well, if I'm alive, I'll get them educated some way. I help people to ensure, as I've done in our own house, that God forbid if anything happens to either me or Anne, that we know that the cost of education will be covered by our life insurance policy. But also I help people to work on providing through savings so that they can pay for the cost of education. So a very simple referral for Joe is, are you a parent? Talk to Joe. Life insurance and business people. So completely different conversation. So on the one hand we have a business person who's a parent, that's one conversation. But the business person and life insurance can be a completely different conversation. People say to me, oh, you have a domestic mortgage, so that's the family piece. But separately they could have substantial commercial mortgage, be it second property or business property, or debt within the business. Again, from a business point of view, that debt should be covered to protect the business should anything happen to the business person. Partnership insurance. I'm sure everyone around the table, everybody in the room has seen a situation where a member of a partnership died, and the devastating effect that can have on the family of the partner, the surviving partner, and the relationship of the business then, the relationship with the banks, the suppliers, and the customer. So I can put funds in place to make sure that there's a smooth transition of the surviving part of the partnership from the estate of the deceased into the continuing ownership of the continuing partner. And the other one is estate planning. The number of people in this room who, God forbid, if they were to die in the morning, would create an inheritance tax liability for their kids. Terrible, Edwin and I, on an ongoing basis, are working with people for whom the light is going on and who are realising that if your estate is worth more than $225,000 per child, so 3 kids, if your estate's worth $750,000, and it's not hard to get to that, believe me, then your kids are looking at a potential inheritance tax liability of 33% of every penny above that. And there are things that we can use, tax planning, life insurance, to mitigate that liability. So, again, are you in business? Talk to Joe. There's stuff that I can help people with that can make a significant difference. I went to a meeting in Derry with a guy yesterday for a sandwich at 1 o'clock. I was supposed to be out of there at 1:30. We got into this conversation and had to drag myself away from the guy at 3:30. So I have a huge amount more in this presentation. I'm going to complete hash of the timing of it. There are a lot of other areas that I help people with. Just to mention one other one, and that's the whole retirement space. There's a slide of a gold watch here somewhere. Does anybody here know anybody who's in business who will eventually retire? Help me out. Referral slips by the end of today. I've been doing the retirement thing for the last 25 years. I really enjoy it. If you don't mind me saying so, I'm really good at it. I know the ins and outs. I know how to get the tax-free cash and the tax relief and all of that stuff. When should you talk to Joe about retiring? Not when you're 60 or 65, the day you start work. In conclusion, ladies and gentlemen, I'm delighted and honoured to be a 2-year member of this chapter, having been around since the very beginning. I would like to thank you all for your referrals and your own business, even more importantly. And I'm honoured and will be honoured to help any of your referrals make their way through the quagmire that is the financial services industry.